In terms of what our course outline has been over the last 4 weeks, so we've gone through, the first week we went through fundamentals. We spoke about budgeting and why budgeting is of extreme importance. And I hope everyone has at least made their budget and started to work towards sticking to it. Then the second week we went through savings, went through some tools that you can use to do savings, and we went through strategic uses of debt. And we went through a few more details about some debts, for example, credit cards, mortgages, and car loans and how they work. Then last week we went through investment. It was just investment 101. So we just went through the basics of investment. We went through stocks in a bit more detail. We spoke about how you can use other ways to invest, like money market funds. And most importantly, was also around risk reward, because for you to decide where to put your money, you really need to understand the risk versus the reward. Then today, in this last week, so we'll go through how to protect your wealth, and then just some final tips in terms of how to achieve financial independence. So in terms of house rules, as always, this session is for you. Feel free to ask questions. Let's be as interactive as possible. And feel free to share, because whatever happens in this classroom will stay in this classroom. So as always, we start with one question. So hoping you can be able to see the question and answer it. So the question today is, what is the one thing you yourself that you have learned from this course? Maybe one thing that has really shocked you, or one thing that you really has made you really rethink what you're doing in terms of your personal finances. So whoever is willing to share, please feel free to raise your hand or just unmute and share, or you can even just type in the chat box and I will read it out. So what's one thing that has really shocked you, or something that has been a real wow, aha moment, that kind of a thing? So I can see, Liz, you said, Mutavuta, you said you can hear me. So thank you also for confirming that. I'm hoping the slides are moving as well, just to make sure that we can all follow the conversation. So we should be on a slide that's asking a question about what is the one thing that you have learned or you have challenged yourself to do as a result of this course. Anybody? So Mercy, you say your aha moment has been understanding how compound interest works. Thank you very much. So that was in our first week, and I'm really happy to hear that, because yeah, if you understand compound interest, then you'll understand why it's important to start early, and also how to make sure that you're not the one paying the compound interest, but you're the one earning it. So thanks for sharing, Mercy. Anybody else with an aha moment or something that they learned? So Ruth, you're saying, I appreciate the knowledge of future value of money and the compound interest. Thanks for that as well. Yeah, time value of money is also a very important concept, because once you understand that, you'll be able to tackle and smartly know where to save or invest your money. Okay, I'll give one more minute for anyone else who has something they want to share. Something that they've challenged themselves or they've learned as a result of this course. Okay, I think let's continue. Thanks for those who've shared what they've learned, but feel free to also just type in the chat box, and I'll read those out as we continue. So as always, there's always a reason behind the question that I ask. And for today's question, the reason is actually because of this quote from Mahatma Gandhi, where he said, "It is unwise to be too sure of your own wisdom. It is healthy to be reminded that even the strongest of people can weaken, and even the wisest can make errors." So this is the reason why we're doing this last part about protecting your investment, because if you're too sure of your own wisdom and you don't necessarily take the steps to protect your investment, you'll very easily get into an error and you could easily lose a lot of your investment. And that's why it's important to understand how to protect it and how to not be too greedy in terms of managing your investment. So Ruth, I can see as well you've said that budgeting was key. You learned how to direct your money where to go and not figuring out where it went. So thank you for that quote. You're a victim of figuring out where your money went, and that's your biggest take home. So thanks for sharing that, Ruth. Okay, so in today's course, we'll go through this bit. So we'll go through how to protect your wealth. We'll talk about insurance. We'll talk a bit about different types of insurance, when to use them, and then we'll go through some final tips. And of course, if there's questions, if there's anywhere you need feedback, or you have a challenge, please feel free to reach out and ask questions as always. So in terms of protecting your wealth, so let's understand first of all just how insurance works. And basically it's what you can call the insurance promise. So insurance basically is you do a lot of hard work to create your wealth. So because of all the hard work that you do, you basically need to protect your wealth. And that's where insurance comes in. So people take insurance to protect themselves from major financial losses. And there's many different types of insurance, which we'll go through some in detail today. And insurance basically works on a promise that if you do suffer a loss that they've agreed to refund you on, what happens is they simply reimburse you to the point before that loss happened. So for example, if you take out car insurance and you insure your car for 1 million shillings, just throwing a random figure, what happens is they refund you 1 million shillings in case your car does get into an accident. Of course, there's a bit more than just saying they'll refund you 1 million, because there's the bit of whether it was your fault that the car had an accident or it was not. And also they do factor in a bit of the devaluation, because a car is a devaluating asset. So basically the whole premise is they try as much as possible to take you back to the level you were before the loss happened. But of course, they're a business. So in terms of how it works, so there's many types of insurance policies. There's health insurance, there's life insurance, there's home insurance, there's renters insurance, which you can just call content insurance, and then there is also car insurance. So we'll go through a bit of them in detail. So in terms of car insurance, how does that work? So usually you're required to take car insurance by law, because you if you don't have a valid insurance sticker, what happens is you'll be stopped and you could easily have to part with a lot of money in terms of fines or any other form of cash that you have to pay out, because it's by law you're required to have car insurance. And it usually protects you in case you do get into an accident, in case your car goes on fire, and in case there is theft. However, there are some risks that are not usually covered as just the basics. Therefore, you have to be careful if you want to take the right level of insurance. So good example is, for those who remember Westgate and the issue that happened in Westgate, where the terrorists came in and the whole what was it called? The whole car park basically fell, and a lot of cars were damaged as a result of that. Believe it or not, many of those people who had parked cars within the Westgate shopping mall were actually not compensated, because they had not insured their cars against terrorism as a risk. So it's important for you to understand what type of policy you are. And given the kind of country we live in, where we know tomorrow there could be protesters on the street, and they could easily start throwing stones at you. And at the same time, terrorism does happen a lot. So you might come out alive, but because you had not insured your car versus terrorism or political risk, then you end up losing your car, and you have to take care of the damage and the repairs by yourself. So that's one thing. And then in terms of there's something, so the law requires you to have at least third-party insurance, and it's important to understand who are the three parties who are involved whenever you're taking out car insurance. So of course, the first party is yourself, because you're the one who goes to the insurance company and you say, I want to insure my car. So you're the first party in that agreement. Then the second party, of course, is the insurance, who says, we will cover you in case your car goes on fire or in case you do get into an accident. And then the third party is basically the person who is not you and is not the insurance, but in an accident, they could either be injured or they could be the one who caused the accident. So in terms of third-party insurance, the only person who is covered is the third party. So the third party is, assuming I'm driving my car and I do hit somebody, whether it's a person or another car, that third party is the one who gets paid for the damage that I've caused to them. But myself, I do not get paid in terms of the damage on my car. However, there's what they call comprehensive insurance. And comprehensive insurance basically covers all three parties. So assuming I'm driving my car and then I do happen to cause an accident, so I hit somebody else's car, what happens is both my car and the other person's car will be fixed, because the insurance is basically covering all the parties involved in the agreement. Okay. So that's why it's important to differentiate between third-party insurance and comprehensive insurance. And then in terms of when you're taking the insurance, so it's important considerations are, number one, to understand what risks are covered when you take out the car insurance policy. Don't just think about the price and say this person is offering me 2% versus somebody else who's offering me 5%. And most of the time you'll find that if you just add a few hundred shillings or even maximum 1,000, 2,000 shillings, then you'll be covered for these additional risks. And remember, because we live in a country where political risks happen, terrorism happens a lot, that's something to consider for you to be able to be a bit more stress-free. Somebody could be thinking, okay, maybe I'm not at the level where I have a car, so why do I really care about this? So, at this point, maybe you're not there, but remember, as we are taking this journey, we're working towards being financially better. And one day you could be at that point. And that's why it's important to understand this, so that when you do get your car, or in case you do have one already, you'll be able to know how to handle and what's the best insurance for you to take out. And like I always say, I'm not affiliated with any insurance, so I'm not giving any information for any insurance or trying to tell you to sell you anything. So feel free to assess insurers based on your own analysis, but these are just some of the things for you to consider when you're taking out a policy. So the second one that we'll go through is home insurance. And again, somebody could be asking themselves, why should I care about home insurance yet where I live, I'm currently renting, it's not my own place? It's because there's two forms of home insurance. So you could protect your contents of your home, and you could protect both the house itself and the contents. And I'll tell you a story about one of my very close friends. So what happened is, as a result of where he works, some insurers came, some agents came, and they sold him an insurance policy that basically covered his house contents. And where he lived, he took out the insurance and even forgot about it. Then at some point, what happened is he came at home one day, he found that his house had been broken into. And at that point, a lot of things, the electronics had been stolen from his house. And of course, he did suffer a very huge loss. So thankfully, he remembered that he had the insurance, which he took out, but it was actually a garage purchase for himself. But when he went out and filled in the claim and said, my house was broken into, he was actually refunded, and he was able to buy back all the things that had been stolen from his house. And trust me, this insurance is not expensive at all, because home breakages don't happen as much. And at least these days, it's a lot more safer, depending on where you live, of course. So what do they cover? So they cover home break-ins. They cover in case you have somebody who you live with, could be like your domestic worker, your house help, or something like that, and they decide to either orchestrate the theft, or they decide to be the ones who steal from you. And sometimes also electrical faults happen. So sometimes lights flicker, and then when they come back, when you go to switch on your fridge, you discover your fridge is not working, because it's now, because of that electrical fault, it's basically been burnt up. So it also covers that most of the time. And usually something as little as 10,000 shillings per year, which is less than 1,000 bob a month, can cover you for up to 1 million of your house contents per year. I mean, yeah, 1 million of your house contents. In terms of what to consider, so some policies do offer also protecting movable objects. So movable objects could be if you own a laptop, if you own a phone, if you own expensive jewelry, you can basically say, I own a laptop worth 10,000 shillings, I own a phone worth 50, I own some jewelry, my wedding ring, my necklace, they are worth maybe 10,000 shillings. And they also protect non-movable items like TVs, fridges, and sofas, which are usually in your house and you don't move around with. So if you do consider taking this insurance, remember it's usually very cheap, and especially if the thing that makes it expensive is usually the movable items like your laptop, your phone, because those ones are more likely to be stolen than the non-movable items like the TV and the fridge. So if you're able to take out the insurance, depending on how you structure and your items, you'll find yourself, you'll pay as little as 5,000 shillings every year. It's not every month, it's 5,000 shillings every year. So if you spread that out over 1 year, you'll easily have find yourself that you're paying between 500 shillings to 1,000 shillings. And when shit does happen, pardon my French, but when things do go wrong, then you find yourself in a much better situation, because the insurance will simply pay you back for the items that you've lost. So the other one is health insurance. Most of the time, I think this is the biggest piece that we as Kenyans actually ignore, but it's one of the ones that really causes families to be in debt and to have burden. So health insurance is basically where you pay some money every year, and in case you do have medical bills, then the insurance then basically takes care of those. And the thing that I find most of the time is that people think about health insurance as a saving. So if I'm paying my own health insurance and I pay, say, for example, 2,000 shillings a month for it, then I expect to get at the minimum 3,000 every month out of it. So even if I have a flu, even if I have a very light illness, I'll go to hospital because I want kind of to use my money. So that's one way to look at it, and it's fine, depending on who you are and how you prefer to look at things. But the most important is, at the moment, you'll have a very rainy day. So today you could be walking outside there, you fall into somewhere and you twist your leg and you have to put a cast and all those things. Even if the cost of that putting the cast is 5,000, remember for that 1 month, you've recouped a lot more than what you've paid to the insurance. And I know many people can attest to this, whether it's you or it's somebody you know. You could find situations where family members end up taking out debt because you have to pay medical bills for different family members. Could be your parents, your aunties, your uncles, your cousins, your brothers, your sisters, because we don't really have medical insurance for ourselves. Then there's a very interesting research that was done that actually found that most people, I mean, and something that we cannot relate to, we do a lot of self-medication. So you go to the chemist, you basically say, this is how I'm feeling, and the person administers to you whatever drug, and your situation kind of heals. So it's one way to do it, but at the same time, this practice, because sometimes you find yourself abusing the medication, then you find yourself in a situation where when you do actually get sick, then the situation is not able to be tackled by these light drugs because your body is used to them a lot because you've really abused the drug. So that's an important consideration for especially for health insurance. Why is it important to have health insurance? Hello, sorry about that. Looks like my connection had an issue. I'm hoping you can hear me now. Please just let me know if you can hear me. John, thank you. I've seen you saying that you can hear me. Cool. And Marcy as well, you've confirmed you can hear me. So let me just repeat this section when I was talking about health insurance and the fact that the earlier you join, the better, because that's where I think I dropped off. But again, in case there's any questions, please feel free to ask or something that's not clear. So basically for medical insurance, like I was saying, the earlier you join, the better. Usually insurers allow you to join if you're less than 65 and you can continue paying even when you do get past 65. And if you're in a position to be able to take out insurance for your parents, please do that, because the older they get, the more the medical expenses become, and it will be very easy for you to manage it if you have medical insurance versus if you don't. In terms of cost, usually for about 100,000 per year, which is about between 8 to 10,000 per month, then you can be able to manage it. Of course, depending on what your income is, not everyone is blessed in the same way. So the important thing here is to make sure that you don't let medical issues wipe out your savings. The earlier you can be able to get a medical cover for yourself, for your family, especially if you don't have one through your employer, please do that, because it will really help you and take care of you when you're sick or when you do get into an accident. In terms of important considerations for this, so of course there's the outpatient versus the inpatient cover. So make sure you have the right one for your family size. So depending on if you have a child versus if you don't have a child, then the amount will really differ. And at the same time, if as you get older, then your inpatient will need to move to be a bit bigger because you're more likely to be hospitalized than if you're a bit younger. So, but then those are just considerations that you'll take as time goes. So just checking in case there's any questions up to here, or if I'm being clear. So we've gone through car insurance, we've gone through health insurance, and we've gone through, yeah. So I don't know if there's any questions. I can't see any of the chat, but just want to make sure that we are following and I'm not leaving anyone behind. So maybe you can type just a quick note in case you don't have any question, in case you're following. Okay, so CNN has said you're following. Ruth, you're asking if you're in the matatu industry and it had an accident, does it mean if you had a third party, the matatu won't be compensated? I think that's a good question. So matatus usually are a bit different because the third party in the matatu case is usually the reason why matatus are required to have public service vehicle licenses because the occupants, you're also counted as a third party because you're not the owner of the matatu and you're not the insurer. So usually matatu is a bit different. That's why they're required to have a public service vehicle license and an insurance. So most of the time you are covered if the matatu had valid insurance. However, not many people go back to claim because most probably you won't even have the number plate of the car. You won't know a lot of things. That's why it's a bit hard to claim. But in case you do have those records, then if you make a claim, then you can get paid in case of an accident. So I hope I've answered that, Truth. Okay, so John also had a good question. So John, you've asked, is the driver of the car covered, say in third party and comprehensive? So usually when you take out, remember when I explained the three parties? So you are the first party, the second party is the insurer, and the third party is anyone else who's not the two of you. So if you have third party insurance, you are not covered as the driver because you're the first party. So especially if it's a private car, whether you're the driver or you're the owner, you're not covered because you're the first party. For private, they basically assume if you're the driver, then you've been given the permission by the owner of the car. So they don't cover you in case it's third party. But the flip side of comprehensive is that comprehensive covers everyone. So it covers you as the first party, covers the insurance as a second party, and covers any other party who's involved in that whole accident. So for comprehensive, yes, the driver is covered. For third party, no, you're not. Then Mercy, you have a question. Can NHIF be considered as health insurance, or what should one consider when picking a health insurance? So I think that's also a very brilliant question. Of late, NHIF has actually really become much better as an insurance fund. So at this moment, yes, you can consider NHIF as a health insurance. It does provide very good outpatient, not good, but okayish outpatient. It does provide okayish inpatient cover as well. And even for the elderly, it does provide good cover. And it's not very costly. So NHIF is just shy of 500 shillings a month in case you're paying yourself. And if you're paying through your insurance, through your employer, it's slightly higher depending on your salary grade, but I think the maximum is about 1,000 or 2,000. I can't remember the exact number. So NHIF of late has become decent. And actually, in case you're not able to do a private medical insurance, then please at the minimum make sure you have NHIF. NHIF is just 500 bob a month. In case you do have more people in your family, just make sure you add them to your card. So in case you have a husband, add him there. In case you have a wife, add them there. In case you have children, add them there to NHIF. Because even if they take up a bit of the bill, it still comes along when it will not wipe out your saving in case you have an accident or you have illness. Okay, then John also has another question. You're asking, are there insurance companies covering people older than 65? Most of them cover up to 60 years. So I think this is what I was explaining, John, where I was saying that insurance, the earlier you join, the better. So if the insurer says that the age that they cover up to is 60, usually what it means is that if you join before you're 60, then they'll cover you. Even when you get to 61, provided you continue paying, they'll cover you. But if you try to join when you're 70, then they'll basically deny you because they don't cover you when you're past that age. So the trick is to join earlier. So in case your parents, if you shop around for insurance and you discover most of them only take up to 60, so in case your parents are just at 59 or 58, please ask them to take insurance now. You can, if you have the ability, you can pay for their behalf. In case they're already past 60, then the most important is to at least have NHIF, because NHIF will also cover a bit of the medical bills should they be required. So I hope I've answered those questions that I've seen so far. So John, you've said thanks. You're welcome. I'm just checking in case there's any more questions, just to make sure that we are all following together. Okay, cool. If we don't have any more questions, I think let's move on to life insurance. So life insurance, so again, using the same framework that we've used to assess the others. So basically this one offers financial protection to your parents, to your spouse, to your children when you're not there. So how it works is you basically say that if you're not there, then you want the insurer to pay your family a certain amount, depending on how much you'd insured your life for. If you are employed, most employers offer actually not offer, they are required by law to offer their employee what is called work injury benefit, and it usually pays out about 8 years salary for you in case you die while you're still employed by the company. So if your annual salary, so if your yearly salary is 1 million shillings, then they basically pay out to your family 8 million shillings. But of course, there's tax in all those things, so it won't be exactly 8, it will be slightly less than 8. But the principle basically applies that they pay out 8 years worth of your salary to your dependents, who could be your children, your spouse, and depending on who you nominated. So it's important to, if you're employed, make sure that your records are up to date. In case you get married, please add your spouse, add your children, because if you don't add them, when they do come to claim, then the insurer could refuse to pay or could delay the payment process because of the fact that they need to verify if this is really your spouse, if these are really your children, and those kind of things. And again, in all this, it's not saying that we are planning for the worst, but it's just preparing, because we know that death is inevitable. Everybody dies, so the earlier you can prepare, the better. And I know it's a very tough topic, especially for us Africans, but please bear with me and try to plan for it. So life insurance is not a replacement for savings. Don't think about, in case you do get a good insurance agent, please don't let them lie to you and tell you that it's a good replacement for your savings. It is not. And that's why when we went through this course, we spoke about how to evaluate savings and your return on your investment. So please do that. What you'll discover is life insurance just gives you a very basic interest rate of between 1% to 2% per year, which is nothing good compared to how we went through some investment systems and how we went through some tools for saving, which can give you as high as 8, 9, 10% interest. So don't think about it as an investment. Please let nobody lie to you that it's an investment as well. So why is it important? Again, it does pay you in case of any accident, in case of illness. So most of the time, if you do get, for example, an injury that prevents you from going back to work, and you do get disabled or something like that, most of the time life insurance will still pay your family or pay you for the life insurance. And basically, like I said, it protects your loved ones when you're not able to do it. And to give you an example, there's a family I knew growing up that unfortunately the parents did pass on in an accident, in a car accident. But then because the parents had taken life insurance, or what we would call education policies, the children were still able to go to very good schools. And even when they got to campus level, the insurance still paid for them campus. And I think they actually went to study abroad because the policy that had been taken was actually a very good one. So I think that's the power of life, of education insurance and life insurance. So if you can be able to take a policy, please do it. But remember, please do not evaluate it as a saving. It is not a saving. It's basically protecting your loved ones when you're not able to. Then lastly, in terms of important considerations, make sure you understand what is covered, for how long you'll be required to pay or to contribute, and what happens in case you don't pay the contributions, or in case you're not able to pay the contributions. Most of the time, if you try to ask these questions to the insurance agents, they will be very dodgy with the information. But please make sure you ask those tough questions, because the more you know, the better you'll be able to evaluate the different companies and the different policies for you to understand which is the right one for the need you're trying to address at the time. And lastly, of course, keep the policy document close. This will definitely come in handy before the insurance does pay you. So today's lesson is a bit short. We'll have a bit more time for questions in case there are any questions. So I think as a summary for insurance, basically, make sure you understand your needs. As I mentioned, we've gone through those 4, which are usually the common ones for everyone. Make sure you understand which one suits you. At the minimum, I think work on, first of all, medical insurance. We did speak about NHIF being a very good alternative if you're not able to pay for private insurance. So you can start off with NHIF, and then over time you can start considering where else. If you're employed, most of the time your employer will offer you that. If you're not employed, please take it up for yourself. And then make sure you choose wisely. The thing about insurance is it's most of the time, remember, you're dealing with a corporate, and the company is also out to make money. So make sure you pick the right insurance policy for yourself. Shop wisely, evaluate companies for you to be able to find the right one for yourself before you make the final decision. And then lastly, the reason why I say never stop paying is because put it in as a budget for yourself. So insurance is not like a saving. It's not that you're putting money and at the end of the year, if you put in, let's say for medical, if you put in 100,000 and you only manage to go to hospital once, and the insurance only paid for you 10,000. So you say, okay, let me stop paying because I lost 90K. Don't think about it that way. It is not a saving. And even, for example, for life insurance, like I said, it is not a saving. But when things do go the other side, and we know life always happens, people do get accidents, people get sick, and all this, like I said, it's not wishing anybody any bad luck, but we just know it always happens. So that's where insurance really comes back, and it will pay you back for all those years that you've been paying, because you still had a valid policy at the point when things did go wrong. And like I said, provided you can afford it, please pay it. Of course, if you can't, you'll reconsider it in your expenses, and you might decide to pause for a while before you go back, let's say when you do get a future job. So that's it for today's session. So as always, we finish with a quote. Today's quote is just a very interesting one, I hope, for everyone. When you start taking your personal financial journey, people will always ask you, why are you doing it? In case, for example, you choose to spend time rather than spend money, you choose to be at home a lot more, you choose to find ways to spend time without spending money, and you maybe reduce the number of times you go out, you reduce the number of times you go to eat in restaurants and stuff like that. People will always ask you why you're doing it. But trust me, when they do see the fruits, because this does take time, what will happen is they'll ask you how you did it, and it will be too late for them. So start early. Do start putting aside money for saving by having the right budget and sticking to a saving schedule. Evaluate investments, choose the right one for you, choose the right tools for saving. And trust me, when you do look at yourself 5 years from today, you'll be a much different person from who you were when we started this. So I think that's it from me. In case there's any other question, please feel free to ask. So I'm just checking in the chat box in case there's any question I may have missed. Okay, so Ruth, you're saying thank you for the session. You are most welcome. So as always, in case there's also a question after this class, you don't have to, maybe for today you might not have a question, but in future you could have one. So you could use the same number that we've been using to send you reminders to reach out. And at the same time, we also have our email on our website. So you can reach out to me in any of those ways, and I'll be able to help you in case there's any more questions. And as always, I will send the recordings, I will send the deck so you can refer to it, and you can also teach your friends for them to be wiser on money as well. So John, you're saying thank you for the session. You're welcome as well. Sarah is also saying thank you for enlightening us. The sessions were helpful. Do you have more courses? So in the new year, yes, we will. I haven't prepared what the calendar will look like, but we will possibly have more sessions starting off in January. We're just taking a break for December for now. Okay, so I think, thank you everyone. You have been an awesome audience. I can see one question here from Ruth who's saying, just wondering, we have seen banks and big supermarkets shut down. Does this happen to the insurance industry? And if yes, what happens to the policies? I think that's also an amazing question. So the important thing is to make sure that you choose the right insurance company. So what we've seen happening to supermarkets like Tuskys, like Nakumat, even ShopRite has also closed because they have not been able to manage business. So I would say the two things is, number one, choose the right company from the onset. Usually betting on a bigger company is better than betting on a smaller company. So the big companies, of course, would be the likes of Jubilee, CIC, those ones. So it's much safer to go with a bigger company. There's something that's called too big to fail. So usually if a company is very big, then they'll likely be even saved by the government in case they're about to collapse. On the other side as well, if you do get into a company and let's say you see a situation where the company could be going down, as early as possible, evaluate the decision. That's why it's important to follow a bit of what's happening in the news, and especially if you've put in any savings or that's where you invest your money, always follow what's happening in the news. And if you do see an early warning sign, then you can either evaluate whether you need to move your money to somewhere safe, or if it's still a situation, you can stay. So I hope I've answered that question, Ruth. I'm seeing one from Stacy who's asking just a question on retirement. What is the best personal retirement scheme you can recommend? I think that's also a good question. So we didn't cover retirement in this particular course, but it's because retirement can either fit into investment or can fit into saving. So for me, I think it's less about the best scheme and more about what is the return you're getting from the scheme. So if you put your money in a scheme that gives you 5% return, then you're in a much worse situation than if you put your money in a saving, like a money market or a balance fund or somewhere else where you could get a bit more as interest. That said, there are many personal retirement schemes that exist. You can check some of the big companies. So we have companies like Sanlam. Sanlam does do a lot of retirement schemes for the government, like for teachers. So you can be sure that your money is safe, because you can imagine if they manage the retirement scheme for teachers, first of all, it's a big scheme, because in terms of the numbers, both from contributions and the number of people in the scheme, that's number one. So again, coming to that principle of too big to fail, that would be one of the companies that might be considered to be too big to fail. But please assess the return that you're getting from them as a retirement scheme. You can always ask them for previous year financials. They'll be happy to share with you, because they are required by law to share them with the public. So they'll either direct you to their website where these are, or you can be able to ask and they will send them to you, and then evaluate whether it's the right place for you to save for retirement or not. The bad thing about Kenya is we don't have a lot of information on retirement schemes, because it's not as concrete as other countries. But for me, I would say look at the return. You might find it might make more sense for you to save the money somewhere else than to actually invest in a retirement scheme in some situations. Then John, you're saying consider inviting us for a risk management course, especially risk management framework. Thank you. That's well noted. We will consider that for next time. Mercy, you're asking what's your take on SACCOs, the advantages and disadvantages. And so I think SACCOs are quite interesting in that SACCOs are very good saving schemes. When we went through the course on savings, I did highlight about SACCOs, and I did talk about SACCOs being the disadvantage of SACCOs is that when you want to take out your money, then in some SACCOs, it's very hard for you to take out your money. So my suggestion would be, when you're deciding on which SACCO to invest your money, number one, understand their performance, because there are many SACCOs that give very little dividends or no dividends at all. So understand what is the dividend history for the SACCO. That's number one. Number two, understand if you want to take out your money. So if today you want to say move your money from the SACCO to somewhere else, what would that mean? Many SACCOs might tell you can only get your money in 90 days, in 60 days, something like that. Or they might actually require you to sell your shares to somebody else. They could tell you, find somebody who's willing to put in, let's say you've put in 1 million shillings into the SACCO. They could tell you, find somebody who's willing to put in 1 million shillings. They give you the 1 million in cash, and then you transfer basically your savings from your account to that person's account, which of course is an inconvenience and very hard. So please be careful on SACCOs. Decide why you want to put money. The thing about SACCOs is that they're very good in terms of taking loans. So if you're topping up money to your SACCO account with the hope of you taking out a big loan, then also evaluate that as the benefit, and be careful when you do want to take out your money, what happens, because you could find that you will top up the money, take a big loan, and then 5 years later, after you've paid the loan, you want to take out your money, and the SACCO refuses you or tells you have to find somebody to exchange basically money versus what is in your account. So that's my take on SACCOs. I hope I've answered that, Mercy. You are welcome. Cool. So yeah, I think if we don't have any other questions, we can We have one more question. So Simon, you're saying enlightening session. Looking forward to more. You are most welcome. And please keep checking our website. Keep checking our. I'll keep sending notifications when we do have new things. If something is interesting to you, please feel free to sign up. So, for example, on Thursday we have a session on toxic line managers, which could be interesting. Whether you have a very bad boss right now or not. So the session is not just how to handle a bad boss, but in the future you could also be the boss. So how do you avoid being labeled as a bad boss? So that's what we'll be focusing on Thursday's session. So feel free to sign up for it as well. Cool. I think that's it. I'm not seeing any other questions. So thank you very much, everyone. You have been an awesome audience. We will prepare your certificates and send them out to you within the course of this week, if not early next week. And at the same time, you'll get all the handouts, all the recordings, so that you can view them in future. We'll move them to YouTube, where it will be a bit more permanent versus having them on Zoom. So you'll be able to access all the recordings today and in future, and you can also share out with your friends, your colleagues, let them learn also about financial wellness. So thanks, everyone. You have been an awesome audience, and do have yourselves a very, very good day, good night, and good end to the year. Thanks. Bye.